Currency contracts are usually traded in standardized units called lots. Lots are delineated in increments of $1,000, $10,000, or $100,000 of the base currency. If we're looking at a pair where US dollars is the base currency, a $100,000 lot is called a standard lot, $10,000 is called a mini, and $1,000 is called a micro. So let's say you wanted to purchase 200,000 US dollars worth of New Zealand dollars. You would purchase two standard lots, two lots of $100,000 apiece. When you go to purchase amounts less than 100,000 units, the lot size is most often expressed in fractions of a lot. For example, if you were to purchase 10,000, you would enter the order to purchase 0.1 lot. Since a standard lot is 100,000 and 1/10 of that is 10,000. This chart here shows the lot sizes you would type in for some trading amounts. The important thing to notice here is that you can mix and mingle varying lot sizes down to the smallest increment of 1,000 or 1/100th of a standard lot. This relatively new development in the currencies market has opened up a clever way to manage risk. By reducing lot size, you still have an opportunity to profit from a pending move, but without the added risk of trading a standard lot size. That might sound confusing right now, but we'll talk about it more in an upcoming module. In addition to being able to manage lot size by purchasing micro and mini lots, another major benefit to trading the currencies market is your ability to trade with borrowed capital. It's called margin, and trading on margin allows you to trade a very large amount of capital with a very small initial investment. You can think of margin like a line of credit that can only be used to purchase foreign currencies. Only the great thing about your foreign currency line of credit is that it comes standard with every account you open. You don't really have to apply to get it. In the foreign exchange market, your margin, or buying power, is often referred to as leverage. When you open your foreign currency brokerage account, you'll know in advance how much leverage you'll be given. In most cases, your margin is 50 to 100 times your account balance. Suppose you were to open your account with $2,000 balance. Your purchasing power on the foreign currency market would either be $100,000 or $200,000, depending on your leverage. Now, before you get too excited, there are two important things to remember when working with margin. First, you always have to pay it back. If the trade goes for you, you pay the borrowed money back and keep the difference when you're done with the trade. If it goes against you, you have to pay back what you borrowed, and you will have a little less than what you started with. If your leverage trade goes against you too much, the broker will actually close the position for you at zero, or just before you won't have enough money to pay it back. It's highly uncommon, but if the market moves too fast and they can't liquidate your position in time, there could be money that you have to pay back. Hopefully, you can see why it will be necessary to manage your money responsibly with this leveraging power. But that's what we're here to show you how to do. The second thing you have to remember is you always have to maintain a minimum cash balance in your account. For example, if your leverage is 100 times your account balance, then you need to maintain a cash equivalent balance of 1/100th of your investment in your account at all times. Let's put it this way. If you're using $100,000 or one standard lot, then you have to have at least $1,000 in your account. Let's take a look at how leverage works with a real example. You see the indications that the US dollar is going up in comparison to the Japanese yen. So you want to purchase one regular lot, which is going to cost you $100,000. Your broker, however, has given you 100-to-1 leverage. This means that you can borrow $99,000 from your broker as long as you have at least 1% of the lot size in your account. Since you are buying at a 1% margin, 1,000 US dollars are set aside so that you can open up the trade. You now control 100,000 US dollars worth of Japanese yen. Let's assume that the exchange rate does indeed rise 1 cent and you close your position. At first, this might sound like just a slight increase, but that seemingly insignificant climb earned you a cent for every dollar you had leveraged. You made roughly 1,000 US dollars. Be aware that trading currency includes interest charges. These happen at the end of the day. Depending on where you have your money allocated at your broker's cutoff time, you could either pay that interest or earn it. Check this out. In the U.S., if you were to borrow $100,000 at an interest rate of 3%, then deposit that $100,000 in a bank in New Zealand that is paying 6%, then you would conceivably make more on the interest you get from the New Zealand bank than you pay for the money you borrowed from the U.S. It works the other way as well. If you borrowed Swiss francs at a 4% interest rate and bought U.S. dollars at a 3% interest rate, then you would be paying more to borrow the francs than you earn in interest. One big important note here: if you do not hold the currency overnight, then you don't have to pay the interest. Interest is only calculated once a day at midnight, Greenwich Mean Time. So if you liquidate all your positions before this time, then you can borrow the money at no interest cost. Many day traders use this strategy to avoid paying interest.